So what a week. We had more record highs. We had a week where the markets continued to surprise, as well a tax plan that we're talking about. What's behind all of this optimism in your view?
I think the economy is clearly coming out of crisis mode. There is more optimism. Governments that come in recently are not anymore impressed by the crisis. They're looking forward to change their economies. We've seen that here in the US. We're seeing it in some of the European environments where, for example, in France with Macron, there's a forward-looking mood rather than looking back at the crisis and seeing how far we're away from the crisis. And the economy is doing the best it ever has over the last 10 years. This has been the first IMF meeting I attended where the IMF did not revise down their growth forecast, but revised it up. And so growth globally has bottomed out. It's solid at 3.8%, possibly a bit higher. U.S. growth is surprising on the upside. European growth is way above its potential. So we're in the good part of the cycle. The good times are now.
You really are. Another thing that happened this week was that GDP report, 3.3% GDP. Now we've got 2 quarters of 3% plus growth. You make an interesting correlation to energy. I want to talk about that.
Yeah.
So the 3.3% growth that we saw this week, do you think that's sustainable going forward? And tell us why energy is such an important component.
Well, for example, roughly 70% of the rebound of growth around the globe is due to the energy normalizing. Almost the entire pickup of inflation is due to energy prices normalizing again. And actually even trade, 70% of the trade in particular from emerging markets that are energy exporters is due to an energy rebound. So energy investment to the global economy is a bit what China is to global growth. The rebound of energy and energy investments has been the key driver of why the economy is doing better. And of course it will have dynamic effects. And where you look where the economy is, it has uplifted consumer confidence. So the world economy is in a very good place now. We'll probably have 2-3 more years of relatively solid growth, record low unemployment here in the United States, possibly falling, to 3.9 by the end of next year or into 2019, and inflation continuing to be around 1.75, heading up for two quarters, 2% by the end of the last quarter in 2019. So a pretty benign outlook in terms of macro environment, but actually a good time. Yeah. And in Europe as well. So there's some synchronized growth in the world economy, and monetary policy is retreating from crisis mode. And the other thing we've always asked for is don't leave everything to monetary policy. It was a long time that it was the only game in town. Now you're actually starting fiscal policy, step up to the table. And, U.S. fiscal policy is going to have a much bigger impact now that it's a new policy tool that is being used than monetary policy, which has already been expansionary for 10 years. So that's another reason why there is confidence. It will keep the economy going. It's a positive for stock market. If there really is a corporate tax reform and corporate taxes go down to 20% from 35%, that's a major reason why U.S. corporates will invest in the home economy and why they will repatriate profits and not show profits abroad, because taxes are reasonable and they will be, in my view, fueling investments, and that will add to growth over the future.
This is a really big point that you're making, but I wonder if as we are increasing or adding to the picture fiscal policy, we're taking away monetary policy from the Federal Reserve. I mean, as a former head of the Bundesbank, what's your take on what the Federal Reserve is doing right now? Is the Fed raising rates going to choke off an economic recovery that's just gaining traction?
If they would have done it like in last cycles, where basically they raised several times a year and in a very strong series, that would have been a risk. But at the Fed, at the moment, they're very reluctant to do it fast. There's actually voices on both sides of the argument. So we're very sure they're going to raise rates in December again. But unlike the market, we only expect 2 moves next year and maybe 3 moves the year after. At that point, rates will be somewhere between 2.5 and 2.75. And I don't think
low.
It's still low, and the Fed won't go much further. So by historical standards, whilst we're normalizing, we're not really exiting the low interest rate environment. And actually balance sheets of central banks, which have been providing some stimulus, have been at all-time highs and will continue to be very high for some time to come.